What's up, everyone? Welcome back to the Investing Blueprint, where we break down the world of investing step by step. If you're new to investing, the first thing you need to do is understand the basic financial concepts that drive the markets. Without these fundamentals, investing can feel like gambling, and that's not what we want. So today, I'm going to walk you through the most important financial principles that every investor needs to know. So stick around until the end. You'll have a solid foundation to start your investing journey the right way. Let's get into it. 1. Inflation. The silent wealth killer. Let's start with inflation. One of the most important concepts in investing. Inflation is the gradual increase in the price of goods and services over time. It's why a loaf of bread that cost $1 20 years ago might cost $3 today. Now, why does this matter for investing? Because inflation eats away at your money's purchasing power. If your savings sit in a bank account earning 0.5% interest, but inflation is at 3% per year, you're actually losing money in real terms. That's why investing is so important. It helps you grow your wealth faster than inflation. 2. Compound interest. The money multiplier. Next up, let's talk about compound interest, often called the eighth wonder of the world. Here's how it works. When you invest money, it earns interest or returns. Then, those returns get reinvested and start earning more returns. Over time, this cycle repeats, and your money grows exponentially. For example, if you invest $1,000 at a 10% annual return, after 1 year, you'll have $1,000. In year 2, instead of earning 10% on just your original $1,000, you're earning it on $1,000. This small difference snowballs over time, turning a small investment into a massive fortune over decades. That's why starting early is so powerful. Even if you can only invest a little at first, compound interest will do the heavy lifting over time. 3. Risk versus reward. Finding the right balance. Now let's talk about risk versus reward, a concept that separates investors from gamblers. Every investment carries some level of risk, but the key is understanding how much risk you're comfortable with. Generally, higher risk investments like stocks have the potential for higher returns, while lower risk investments like bonds offer smaller but more stable returns. The trick is finding the right balance based on your personal goals and risk tolerance. If you're young and have time on your side, you might take on more risk for potentially higher rewards. But if you're closer to retirement, protecting your wealth becomes more important than chasing high returns. A good rule of thumb: never invest money you can't afford to lose, and always diversify your investments to spread out risk. 4. Diversification. Don't put all your eggs in one basket. Speaking of risk, one of the best ways to protect your money is through diversification. Diversification means spreading your investments across different assets, so that if one investment performs poorly, it won't wipe out your entire portfolio. For example, instead of investing all your money in a single stock, you could invest in a mix of stocks from different industries, some bonds for stability, maybe even real estate or ETFs for further diversification. This way, if one investment goes down, the others help balance out your losses. It's like having a financial safety net. 5. The power of long-term investing. Finally, let's talk about long-term investing. Many beginners make the mistake of trying to get rich overnight by chasing trends, meme stocks, or risky investments. But the real way to build wealth is by investing consistently over time and letting your investments grow. For example, if you invested $500 per month in the S&P 500 over the last 30 years, you'd have over $1.3 million today. And that's without picking any individual stocks. Patience and discipline are key in investing. The market will have ups and downs, but those who stay invested for the long run almost always come out ahead. And there you have it, the 5 fundamental financial concepts you need to understand before you start investing. Inflation, the silent wealth killer. Compound interest, the key to exponential growth. Risk versus reward, finding the right balance. Diversification, protecting your investments. Long-term investing, the real path to wealth. If this video helped you, make sure to like and subscribe for more beginner-friendly investing tips. And let me know in the comments, which of these concepts was the most eye-opening for you? Thanks for watching the Investing Blueprint. Subscribe and help us grow for your daily investing tips.